Hey teammates, welcome to this explainer. I've recently been digging into some absolutely fascinating source material about wealth architecture, and I gotta tell you, it has completely shifted my perspective on how we approach our finances. We're not just going to talk about standard, boring budgeting advice today. Oh no. This research outlines a fundamental rebuild of our entire financial mindset. We are going to completely dismantle a lot of the inherited wisdom we have about money, and step by step, we're going to architect a highly robust system. And honestly, the most compelling part of all this material is the ultimate goal. It's not about hoarding cash or hitting some arbitrary high score in your bank account. The entire system is designed to do one very specific thing: buy back our time.
So the sources we're reviewing start with a rather uncomfortable truth. We are operating inside a financial ecosystem that was not inherently designed to make us wealthy. Actually, it was designed to keep us highly functional. Think of it like a brilliantly engineered treadmill. Your salary hits your account, and the system is already right there waiting for it, with EMIs, the car payments, the endless subscriptions, the constant stream of lifestyle upgrades, and of course, those very real social pressures to keep up appearances. It's calibrated perfectly to keep you just comfortable enough to keep working and just aspirational enough to keep spending, so we remain highly productive for the economy, right? But here's the catch. If we don't actively interrupt that cycle, we never actually become truly free.
Okay, let's dive into this by drawing a powerful contrast that really changes how you view everyday success. Take two hypothetical professionals, Rohit and Simran. They are the exact same age, they are in the exact same salary, and they even live in the same building. Now, Rohit, he looks incredibly successful on the outside. He drives a brand new car, upgrades to the latest phone every single year, and is always posting photos from these expensive foreign trips. But behind the scenes, there is an invisible, suffocating stress. He is drowning in 3 different EMIs and rolling credit card debt. He is literally hemorrhaging his future income invisibly, just to maintain the present illusion. Simran, on the other hand, well, she looks remarkably average. She uses an older phone, doesn't even have a car loan, but her financial frame is bulletproof. She holds 0 bad debt, maintains an aggressive monthly investment habit, and sits on a pristine 6-month emergency fund. At age 45, Rohit will still be forced to wake up and work purely to pay the bank. Simran, she is quietly building a compounding fortress of assets that will eventually give her absolute autonomy over her daily choices. To get from where we are to where Simran is, we absolutely need a blueprint. So here are the 6 architectural steps we'll be exploring today. First, the invisible rules of money. Second, escaping the debt trap. Third, the engine of compounding. Fourth, mapping your investment portfolio. Fifth, building the safety net. And finally, buying back your time.
Let's kick things off with Section 1, the invisible rules of money.
To win this game, the foundational texts on wealth universally point to one ultimate rule that, honestly, most people miss entirely. Here it is. An asset puts money into your pocket while a liability takes money out. It's that simple. The financially literate accumulate assets first, and they let the cash flow from those assets pay for their lifestyle liabilities. To begin building those assets, there are 5 foundational moves we have to execute. First, you must take a brutal financial snapshot. You simply cannot improve what you cannot see. So calculating your exact net worth down to the penny is step 1. Second, implement the 50-30-20 budget framework. That means deliberately allocating 50% of your income to absolute needs, 30% to wants and lifestyle, and an unbreakable 20% directly to savings and investments. Third, build an emergency fund covering 3 to 6 months of living expenses. This right here is what gives you absolute financial immunity against unexpected shocks. Fourth, ruthlessly kill high-interest bad debt. And fifth, automate your systems to pay yourself first. The wealthiest individuals don't rely on superhuman discipline. They just build better automated systems that route their money to investments before emotional temptation even has a chance to kick in.
All right, moving to Section 2, escaping the debt trap.
Before we can build wealth, we really have to respect the devastating math of borrowing. Debt is a highly leveraged weapon. In the hands of the educated, it can build a financial empire. But in the hands of the unaware, it builds a literal prison of obligation. To put this into perspective, if you carry a rolled-over credit card balance in India, you are facing punishing interest rates of anywhere from 36 to 42% per year. Let me be perfectly clear about what the experts say here. This is a mathematical emergency. There is no legitimate legal investment on the planet that guarantees a 40% annual return. So while that debt exists, it acts like a reverse snowball. It actively destroys your net worth silently, compounding against you far faster than any stock market could ever compound for you. It must be cleared immediately. And this brilliantly illustrates the clear dividing line between building that financial empire and building a prison. It all comes down to distinguishing between good and bad debt. Good debt is capital used for things like rental properties or skill-building education. These are investments that actively generate a future yield or fundamentally multiply your personal earning power. You can smartly build an empire with this. Bad debt, on the other hand, like credit cards or personal loans taken out to fund a vacation, funds depreciating lifestyles. It offers absolutely zero financial return while completely draining your monthly cash flow. That is the debt you must eliminate first.
Which brings us to Section 3, the engine of compounding.
Now that our financial defenses are up and the bad debt is cleared out, we can finally shift the narrative from defense to offense. We are entering the engine room, compounding. The critical realization here is that time in the market, not timing the market, is the absolute ultimate ingredient. The math of exponential growth is just staggering. Take the rule of 72. It's a simple formula that tells us how fast our money doubles based on the interest rate. If you leave your money in a standard savings account earning a meager 4%, it takes 18 excruciating years just to double your purchasing power. But if you invest in an instrument returning an average of 12%, your money doubles every 6 years. Now, the psychological difficulty here is that the early curve of compounding feels painfully slow. But if you can just wait it out over 20 or 30 years, that gentle curve becomes miraculously vertical. The exact same starting capital produces profoundly different realities simply based on patience.
But there's a psychological catch that ruins this for so many people, and it's quantified perfectly by this number right here, 3.34%. This represents the Dalbar gap. Historical data over a 30-year period shows that the average mutual fund investor actually underperforms the market index by over 3% annually. So why does this happen? Well, it's because of our own emotional wiring. Investors feel the panic of a market crash and they sell at the absolute bottom. Then they feel the FOMO, the fear of missing out, during a market peak, and they greedily buy at the top. Over a 30-year horizon, this emotional penalty of buying high and selling low costs an average professional over $1 crore in lost potential wealth. No way, right? But it's true.
So, to protect ourselves from falling into that Dalbar gap, the research suggests adopting these 6 absolutely crucial wealth mindset shifts. First, realize that income is not wealth. A high salary means nothing if your expenses match it. Wealth is only what you keep. Second, your mind is your best compounding asset. Investing in your own specialized skills yields infinite returns. Third, prioritize time over timing. Let the years do the heavy lifting rather than trying to outsmart daily market dips. Fourth, fiercely avoid lifestyle inflation. Actually, this is huge. When you get a promotion or a raise, invest the difference instead of instantly rewarding yourself with a luxury car or a bigger apartment. Fifth, view financial failure not as a defeat, but as compound learning that makes your future decisions much sharper. And finally, recognize that delayed gratification isn't a sacrifice at all. It's a strategic trade. You aren't giving up 1,000 rupees today, you are consciously trading it for 30,000 rupees of freedom in the future.
Moving into Section 4, mapping your investment portfolio.
With our mindset locked in, it is time to actually deploy our capital. The core architectural principle here is diversification. And listen, spreading your investments isn't about being timid, it is rational protection, to ensure no single, localized crisis can destroy your entire compounding machine. One of the greatest vehicles for this is the ETF, or Exchange-Traded Fund. I want to define this so everyone is on the exact same page. Instead of agonizing over picking one winning stock and carrying all that localized risk, an ETF allows you to instantly buy a diversified basket of top-performing companies. Because ETFs mechanically track a broad index, rather than paying exorbitant fees to some highly salaried human manager trying to guess the market, they offer ultra-low expense ratios. Keeping those structural fees near zero is precisely what ensures your capital compounds for your own retirement, rather than for a fund manager's bonus.
Now, what's really interesting about this slide is how we blend these instruments together systematically to create what financial architects refer to as the compound machine. This specific breakdown is an aggressive 10-plus-year model portfolio perfectly designed to optimize growth for young professionals. We allocate 45% to large-cap equity indices for steady, highly reliable domestic corporate growth. We push 15% into mid-cap for that aggressive, explosive growth potential. We allocate 15% to international markets. This is crucial because it acts as a currency hedge and grants us access to massive global tech monopolies. We hold 15% in debt instruments to provide stabilizing ballast during sudden market crashes. And finally, 10% in gold acts as a historical hedge against severe inflation. This isn't random at all. It is highly deliberate architectural balance.
Next up, Section 5, Building the Safety Net.
So an engine as powerful as the one we just built requires a really rigid chassis to protect it. We must aggressively shield our compounding machine from being completely derailed by life's unexpected, unavoidable emergencies. Think about it. One uncovered medical crisis can literally wipe out 15 years of disciplined index investing in just 3 weeks of hospital bills. Therefore, securing these 4 insurances is non-negotiable. First, you need pure term life insurance to completely replace your economic value for your dependents. Second, you need comprehensive health insurance that is strictly independent of your employer. Why? Because if you lose your job due to a severe illness, your corporate cover vanishes exactly when you need it most. Third, you need critical illness cover to provide a lump sum if you face a major diagnosis that halts your ability to work. And fourth, you need accident and disability insurance. You really have to understand that professional insurance is not a sunk cost. It is the impenetrable moat that protects the compounding castle you are building.
Furthermore, true protection isn't just about defensive insurance, it's also about offensive income redundancy. Relying solely on a single corporate salary is essentially an extreme structural risk. Imagine building a massive, heavy bridge, right? But it's supported by just one single central pillar. If the economy shifts and you lose that job, your entire financial architecture immediately collapses. The material strongly advocates for shifting away from that single point of failure by building scalable side hustles and multiple streams of income, whether that's through dividend yields, freelance consulting, or creating digital products. Every new, independent stream of income you build acts as an additional load-bearing pillar, creating unshakable financial redundancy.
And finally, Section 6, Buying Back Your Time.
This leads us to the emotional and philosophical climax of everything we've talked about today. Why undergo all this rigorous financial discipline? I mean, it isn't just to sit on a pile of gold like a dragon. It starts with a profound shift in operational mindset, captured brilliantly by Warren Buffett. Do not save what is left after spending. Instead, spend what is left after saving. When you systematically prioritize your savings rate and aggressively deploy it, you eventually unlock what is known as the 25x rule. This is a fascinating mathematical concept that's absolutely central to the FIRE movement, financial independence, retire early. The math dictates that when your invested capital reaches roughly 25 times your annual lifestyle expenses, you hit the ultimate crossover point. Your portfolio yields enough annual return to cover your entire cost of living indefinitely. That means your money is literally making more money than you need to survive.
And that brings us right back to our opening premise, the true definition of wealth. What actually is enough? The most enlightened professionals realize that enough is never just a specific number on a balance sheet. Enough is the quiet, profound morning you wake up and your time is entirely yours. We so often mistake true wealth for the ability to buy depreciating luxury goods just to impress people we barely even know. But true wealth is the absolute, unencumbered freedom of choice. It is the autonomy to say no to a toxic work environment. It's the freedom to spend a random Tuesday afternoon with your family without asking for permission. It's the ability to choose projects that align perfectly with your internal values simply because you want to, not because a crushing monthly EMI demands it.
So as we wrap up this exploration into wealth architecture, I want to leave you with a really powerful question to reflect on. What does your morning actually look like? When you open your eyes, are you waking up to a towering wall of financial obligation, or are you waking up to pure intention and autonomy? It might just be time for us to stop merely counting the hours we spend working to sustain the system and start actively architecting the life we actually want to design. The mathematical rules and the blueprints, they are right here in front of us. The compounding clock is ticking every single day. The only thing left for us to do is begin.
If you want to understand all of this in greater depth, step by step, with real-world examples in rupees and a focus on the Indian context, then I have written a comprehensive book on the subject, titled The Freedom of Compounding, The Complete Guide to Personal Finance and Investing to Grow Your Money Exponentially Through Compounding. It is now available on Amazon. In it, I cover key topics such as compounding, SIPs versus lump sum investments, comparisons among PPF, EPF, and NPS, tax regime decisions, CIBIL scores, and the mindset shifts essential for everyone. It serves as a roadmap, suitable both for beginners and for those who already understand investing but are looking for a structured plan. The link is in the description. Check it out now.